Welcome to today's episode of Fuchs Around and Cal Them Out. I'm your host, Ben Fuchs, with my co-host,
Alex Cal.
And today, I am really excited for this episode because it is things that piss me off. So
grinds my gears.
Yeah, I don't know if we have a license to steal from Peter Griffin on Family Guy. I don't want to get in trouble. But if it
not
was...
Family Guy.
Not Family Guy?
Well, it was Family Guy, but we are not... we shouldn't reference them if we're going to take their content anyway.
Well, I can say whatever I want, and then our producer will clean it up and make sure we don't get sued. And
Fair
if we
enough.
get sued, it'll all be on him, and that'll be okay, right?
I think as long as we make it funny, we'll be okay.
Please don't watch Seth MacFarlane. All right. Did I even say his name right? All right, moving on. So things that are frustrating for me is the unnecessary anxiety that some of our clients feel, because it's like they shouldn't have to worry about this stuff, but they do. And what would you say is one of the number one things that our clients shouldn't have to worry about, but do?
Yeah, I would say Social Security is number one.
Yeah, I mean, Social Security running out. It's like, here's this thing that you've paid into your entire life, your entire working career. And then they're like, hey, no big deal, but we might cut your payment by 24%. Don't worry about it. And you're like, oh, that's cool. I'm retired. Expenses are definitely going down because we don't have inflation. And so that means, let's put it in real numbers. If I was getting $2,000 a month, I'd be getting, what is that, $2,500 a month, somewhere in that ballpark, right? 25. It doesn't matter. I don't mind losing $500 a month. I'm happy. Take that $6,000 a year that I was using. I don't really need that.
I don't need to eat.
Yeah. So, I'm thinking about this, and I'm like, there's so many ways to easily, quickly, immediately fix that problem. You could, instead of capping out what they tax on Social Security. So for those that don't know, if you make $180,000 a year, or if you make $2 million a year, you pay the exact same dollar amount into Social Security from the tax place. So your income is capped out, I think it's like $178,000, somewhere in that ballpark, but you're paying the exact same taxes. How can we fix it? Get rid of that break. I don't think the people making $500,000 need to pay less or the same amount as somebody making $170,000, right? Is that a fair?
It's fair.
Okay. But there's more. If we really want to dive into it, a lot of CEOs, they get paid by stock options, right?
Don't even count in that figure, right?
Don't even count. Great point. Thank you for bringing that up. It does not. They get paid millions and millions of dollars through stock options, and they pay zero Social Security tax when they sell. They may have to pay other taxes. It might not be 15%, it might be 20%, it might be 23.8%, but none of that actually goes to Social Security. And you think, man, if they just put 2% tax on the capital gains that people make millions of dollars sell all the time, man, that would totally fund Social Security, and we'd never have to worry about it again. And then we could be so happy that our billionaires contributed to fixing the Social Security problem. And I'm sure that out of the kindness of their hearts, when you have 9 zeros after your bank account, I'm sure you don't mind paying an extra 2%, right? It's not a big deal?
I don't know. Depends on who you ask.
Oh.
I would say.
Oh. Man, see, I thought we had fixed the problem.
I have no problem with it, but depends on who you ask.
Okay, so when Alex Cal runs for office, we know...
I will not.
First of all, nobody do any Google searches on the guy. Skeletons galore in that closet. We already did. We'll be doing.
I pass background checks.
Oh,
let's be fair.
That's all we need. That's all. And we're not going to go any further because God forbid we find something. That would be horrifying. So the whole idea that people have to worry about Social Security running out, that we have to run different plans and analysis for people if it were to run out, that's something that grinds my gears, that makes me crazy, and also is completely and totally unnecessary. Fair?
No, I would say that's fair.
Okay. You have one about 529 plans?
Yeah, but more about the whole Medicaid spend down.
Tell me more.
Especially with, I understand the state doesn't want to pay for all your care.
I get it.
And especially with the nursing home, it is 14, 15 grand a month. So understandable. But my thing is, why are we including college planning funds in that number? The whole purpose is so that the kids have less debt, to be less of a burden, to then spend more money on other things for the economy.
Yeah, but if they run into problems and they've got if they have to go bankrupt because of student debt, that comes off, right?
No.
Oh, really?
No.
Oh.
Why would it do that?
Yeah, that's crazy.
especially through the government. They're not going to let you do that.
They don't want indentured servants. Anyway, sorry, go ahead. Tell me more.
So especially if, yeah, I understand the parents can access the money. Yeah, they'll pay a penalty, of course. But I don't see how if being for them, the whole idea was, hey, I'm going to set this up for my kids so my kids are in a better position. They're not old enough to own the account, so I have to put it in my name. And then, well, yeah, if you need a long-term care event, thank you for using those funds to help fund that instead.
So you have to drain the 529 account to pay for your long-term care.
Yep.
That
At least
is
in
crazy.
Connecticut.
At least in Connecticut.
Other states may be different story, but Connecticut is a 529 is a spendable asset.
That is incredibly frustrating.
Yeah. Can't gift it out of your name because then you'll run into a penalty on top.
Yeah, I would say that would make the list of things that I would rather have not happen.
I can understand your money,
Yeah,
right? Or your own accounts.
yeah, no, I get that. And I think that, listen, I think that it's fair to a point, right? And I think there's a certain amount of like, what is the system, right? Is the system like, you need to take responsibility for your own care, you need to pay for it. I think there is something to that. And I think there is something to say like, we shouldn't be attaching a burden onto the state. At the same time, if you are in a position where you need care, I do think it's fair for like the state to take care of you. I don't think you have to be kicked out on your own because you have dementia or other scenarios where you can't do 2 or 3 out of the 6 activities of daily living, right? That we judge those by. And so I mean, it's a tough scenario, but if I'm a financial advisor and I'm planning for my client's best interest and not for the state's best interest, I'm going to make sure that they're giving as little as possible to the state.
Yeah.
And understanding that 529s are one of those things that can be taken, we may have to make some different recommendations with those.
Yeah. That's all it is just the sooner we can be in front of it, I mean, great, the state will get less.
Absolutely. All right. So I have another thing that I think really, really frustrates me. And I'm going to lay out my case, and you're going to tell me why I'm wrong, because I'm okay with that. You're allowed to tell me I'm wrong. I'm a firm believer in that.
What if what you say is right?
That's never happened before. But, that's sweet. I'm happy for a one-off. So the majority of people that we meet save their assets, their net worth into their retirement funds. IRAs, 401ks, 457s for government workers, 403bs for teachers and some hospital workers, thrift savings plan if you work for the federal government. You get the idea. And when most people pass along their wealth, it is through that asset that they have the most money in. So let's say that I have a single child, and I have 3, but it makes my argument.
You just want to leave to one.
Yeah, let's say that the other 2 really piss me off, and I'm going to leave the one. Theoretically. You got $2 million in my retirement account. I pass away, it goes all to that child. After 10 years, that child has to take out all of that money. Okay? So what most people do is they take out 10% a year, $200,000 a year, and then they are taxed on that $200,000 as if they made that money. Also, when people inherit money, typically they're at their highest earning potential. So they're making the most money they've ever made in their lives. They're also paying the most money they've ever made. And then they get to inherit this money, and then they're paying tax on all of it as well. And one side of the argument is, woe is me, you just inherited $2 million, stop crying. Which, to be fair, is the side that I'm on half the time. But the other side is, well, wait a minute. I didn't want all this money to go to the federal or the state government. I don't want to be pushing my children to the 37% tax bracket and the 7% state bracket. I don't want 43% of that money that I worked so hard for 50 years to save to now be going to the federal government.
Hold on. Before you said we should pay a little bit more into the Social Security benefit side.
Sure, this isn't going to Social Security.
Well, I mean, going to the government.
Well, again, I don't have a problem paying taxes. I like clean water. I like, I've been in states where you can't drink the tap water. We live in Connecticut. I'm okay with certain things. And, my kids go to public schools, again, things that I'm okay with. But I also want to pay as little in taxes as I possibly can. Just because I don't mind taxing the rich doesn't mean that I want to pay those taxes. Those are totally different. I mean, I think we can understand.
We don't want to fund the government?
No. I didn't say that we don't want to fund the government. I just said I don't want to fund the government.
I don't either.
Not in my backyard, right? I think there should be a prison. I just don't think it should be behind my house, right? Not in my backyard. So I don't want to pay for those taxes. But And I wouldn't necessarily have a problem with the way the system's set up, except that if I had a $100,000 house, and let's say that was worth $2 million, and I'd passed away, and that went to my one heir, they could then sell that $2 million house and pay zero taxes. Yep. Step up on basis, not one dime, not one penny. They get the whole thing tax-free. So here we are where I leave $2 million, and I'm effectively paying 43% over time to the government. So that means $860,000 of that $2 million is now gone to federal and state government. Whereas the real estate, all $2 million goes to the next generation.
Mm-hmm.
And if we think about who has real estate and who has a lot of real estate, typically it's your not necessarily middle class, right? It's people with more. And now when they move the federal estate tax limit up to what, $26 million for a married couple filings, aren't they?
Correct. Yep.
Right. And I think it will be 30 million. Is it 14.99?
It's 13.99 right now, and it'll go to 14.0.
Okay, so it's almost 28 million. Yeah, he does the numbers. I have to Google the stuff when I look at it, but he's got a better mind.
Before the show. No.
I appreciate that. Makes one of us. I'm glad somebody.
I can read your mind sometimes.
It's horrifying. So can my wife, and
some of them are weird.
Good thing I wasn't thinking about you at the time. All right, stay out. But if we can pass on $28 million, completely and totally tax-free, but we have to give away 43% of our 401ks, that would be something that I would say grinds my gears. And it didn't used to be like that, by the way. It used to be that if you inherited money from your 401k or IRA from a parent, you could stretch that out over your lifetime. You could take $20,000, $30,000 a year. You could pay a lot less overall in taxes, and it could be generational. It could last for your entire lifetime. Now, not so much. And so you're forcing people to take it out, which means they're more likely to spend it and more likely to pay more to the government. How does that make you feel?
No, I would agree. I mean, it just hurts our clients, or just hurts everyone in general, especially if the one tool that they push right now is great, save in retirement accounts, all these catch-up contributions and deductions that you get. When, okay, yeah, great, you saved all this money, you don't need it, it's just going to go to the government anyway.
Yeah. The other thing that they did was they pushed back the required distribution age, right? So when you're forced to take money out, at 73 right now, it's about 3.7%, give or take. You divide the total amount of money that you had at the end of the year by 26.5. I don't make these ridiculous rules, but that's what they tell you to do. So you have to take 3, 4, 5% a year while you're alive, but then your kids inherit it and they have to take 10. And they push back when you're forced to take RMD. So in 2033, it'll be 75 years old that you're forced to take out this money. They don't care if the people that own that money take it out. They'd rather they didn't, because the heirs are going to have to pay a lot more in taxes to do it.
Right. Yeah.
And so it's a weird scenario. And so as we see baby boomers passing away, it's almost like this gift to the tax system where when we talk about Roth conversions, there's reasons why it makes more sense for the people that own that money to pay the taxes instead of the next generation, because the next generation, they still have to take all that money out over 10 years, but they don't pay any taxes on that money when they take it out. So if we can control the taxes, if that's important to you, great. Now, listen, I love my kids. They're wonderful. They can get whatever they get. I'm not going to pay the taxes for them. That's just my position. But I have a lot of clients that do care about that, and it's important for us to make sure that they're getting what they need out of the system.
Right.
Now, you have somebody, and we can cut this out if you want to, but that we talked about earlier today, where he's getting a pension, and he's not paying taxes on it because of his service to the country.
Mm-hmm.
But if his wife...
Thank you to him.
Huh?
Thank you to him.
Yeah, thank you to him. Absolutely. But if he passes away, his wife will still get the pension, but will then have to pay taxes on it. Right?
Yeah. So that same benefit would not apply to her. And the same thing for them, they want to leave as much money behind as possible. Right now, they pay nothing in taxes, federal or state. We might as well use the extra room that they have, still pay nothing, right? But let's just slowly siphon off some away.
Or even we take more and we pay more taxes, and we may even pay more money than you would really want to, because the other number that we looked at, right, is when they're married, filing jointly, and they're both alive, their taxes are here. Let's say the pension is $120,000 a year and they don't pay taxes on it, give or take, right? all of a sudden she's paying taxes on $120,000 pension. And then she has to take required minimum distributions.
And she's in a single bracket.
Yeah, and she has to take Social Security, and she's in a single bracket. So her tax bracket goes from 0 to like 24 or 32%. So if they can max out the 22% bracket while they're alive, while they're both alive, right, they're going to be paying a lot less taxes than if he were to pass away and she would take this money on her own and then have to pay all the taxes herself.
Yeah. And they want to leave money behind, so it works out even better.
Right. I found that most of the time when we're doing Roth conversions, it's either because it's going to save one of the two people in the relationship taxes, or because they want to leave money to the next generation. That's usually the catalyst. The other thing for me is when you're going to be forced to take out more from RMDs than you're ever going to spend. You know, so like I've got people that are spending $25,000 a year from the IRA, but they're going to be forced to take out 60. Well, if you're going to have to take it out anyway and pay the taxes anyway, well, let's get ahead of it and make it so that you don't have to pay the taxes ever again on that money, and do that before you're forced to take the RMD. Because you can't convert RMD money to a Roth IRA. And that's something that, you know, people have gotten confused on in the past, but it is what it is. Sir, is there anything else that grinds your gears? Anything that you want to bring up that we haven't talked about?
Other than, you know, kind of going back to real estate, it's deferral's the best game. It's really what it all comes back to. A lot of the time people will say, hey, you know, do these little things or these quick fixes. And honestly, they all kind of come back to defer, you know, whether it be these 1031 exchanges, which just means we go from one real estate to another property without paying any taxes, right?
So I got a question on that. And you, to be fair, Alex knows more about real estate and taxes than I do. And if you don't know this, we can just edit it out. But
I should, hopefully.
If we're doing a 1031 exchange, right? I bought a rental house for $200,000, and then I turned it into a duplex for $400,000, and then a small apartment building for $1 million. And, you know, I've deferred all of the gains every time I move it from one to the next. I sell it and I move to the other one. I never pay the taxes. And let's say that I die. Do my kids still get a step up in basis on that 1031 exchange?
Yeah.
So we've deferred the taxes our entire lives. And then when the children inherit it, they don't pay any taxes at all.
Yeah. And the nice thing is, along the way, while you were still living, you got benefits from depreciation.
Got to depreciate the whole thing over time.
Yeah. So say you bought that $100,000 property. You started with a 2-family, right? Depreciated it for the 27.5 years. You said, hey, I want an apartment now. Your basis that adjusted with, hey, we took all that depreciation. It's like $50,000. You move to this apartment building, still $50,000. But now the apartment's worth $2 million. Could pass away the next day.
No tax at all.
Whole $2 million is included in your gross estate.
So why are we
step up?
Why are we managing stocks and bonds and mutual funds and ETFs? Why aren't we managing real estate? What's wrong with us? Have we been playing this game? You know, Fuchs and Alex Cal out, real estate edition coming up next.
Yeah. Well, real estate's a little bit more. You have that hassle factor, right? Especially if you have, 2, 3, 4 family. Before you get into the commercial space, you have to deal with tenants. Are you even landlord material? Do you understand what can happen? I mean, I've had situations, I've had clients have rental where your tenant gets cancer. They can't pay you. They don't have money to pay you.
You can't kick them out.
No.
What kind of a jerk would kick out a tenant with cancer?
Yeah, so you have to eat that.
And you have to still pay the mortgage if you have one.
Or any other expenses that come up, right? So it's all on you. So if you have no free time, no connections or help around you, and you're barely making things meet, it's not going to work.
I think that in a lot of cases, the people that are successful with real estate here are the ones that are either able to do the work themselves or have family that can help them do it. And if they can't and they have to go to somebody else for all the makeovers, all the redos, it takes either a very, very long time to break even or you never do. And there are often times when we're looking at people, and I'm looking at the actual rate of return. Like they have a rental property, and we're looking at what they spend, what the taxes are, what the insurance is, and what they actually net after taxes, like what they bring home after paying for all that. And if they sold the property, they would clear $400,000, and they're only making like 2% a year for all of that hassle. And there are other times when it's the opposite, right, where they're getting like 13% a year and keep it, and that's wonderful and great. But there are a lot of times I'm like, man, this is a lot of work and you are getting nothing from it.
Unfortunately, that's more common that I see. Even more scarier, sometimes there's no insurance. or there's no lease agreement. And so or even an umbrella policy, all the real estate's in your name. So if someone slips and falls and, everyone's litigious now, it could be gone.
As soon as Alex buys a property, I'm going to retire.
No one's going to know.
After I fall on his property. Anyway.
That's why I have a camera just for you.
Great. I'll wear my green suit. No one will see me. Thank you for hanging around this edition of Fuchs and Cal. Hope you enjoyed the things that bother me a little bit, somewhat. It may be government related, maybe not. But we hope you're having a great day, and see you next time.